If you're retired and go back to work, even if it's part-time, it opens up some significant tax planning opportunities. What are they? I've got 3 of them, that more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. I've done some videos on this before, but the wave of folks that retired during COVID, if you look at the chart of the labor force participation rate, during COVID, it dropped like a rock. It dropped several percentage points, okay? And then as things reopened, it started coming back, but we were fully reopened and it was only halfway back, meaning a lot of people didn't return to the workforce, and either because they were concerned, they got stimulus money, or the stock market boosted their ability to retire and they just didn't want to work again. Who knows, right? There's just a ton of reasons. We all know personal reasons that, you have examples of that, but still, this is part of the reason why there is such a tight labor market, because we're still missing millions of people from the workforce. What's interesting is they're trying to do some studies on those folks that retired, how many of them have stayed retired, and a significant amount, more than ever before, of folks that have retired have re-entered the workforce. And you can look and say, well, yeah, the stock market dropped and now they're returning, or they're no longer as worried about COVID, they're returning. I don't know what the answer. My guess is it's more stock market dropped. I thought my investments had now gone up 50%, and I was riding high, and now they've dropped 20, and maybe I need to go back to work. That's my guess. Had an individual just this week, and we do tax planning. You guys know this, and we just absolutely love it. Financial planning, there's 6 areas to everyone's financial life. Your present financial position, so that's cash, it's cash flow, it's debt management, those sorts of things. Protection planning, how do you manage the 5 major financial risks that we all face? Do you transfer those risks to an insurance company? Are you self-insured? How do you manage those risks? Tax planning, that's where you get proactive about your tax situation to identify opportunities, to identify and then employ opportunities to save, to pay the least amount of tax over your lifetime, to save taxes. Investment planning, what do you have? How's it structured? What are your investment strategies? How much risk are you taking? Retirement and college planning, long-term planning, how much are you saving? Where do you want to be? Are you on track? What adjustments do you need to make? And then lastly, estate planning. What are your intentions if something happens to you? And if you need assistance, what are your contingency plans? Is everything tied up there or set up the way you'd want it? So those are the 6 areas that apply to your financial life, my financial life, Warren Buffett's financial life, everyone's financial life. And the big idea with the Wise Money Show, and guys, this is what we've been practicing for over 20 years, and we've just wanted to communicate it to the world. The big idea is when you're making financial decisions, you've got to look at all 6 areas to make great decisions. If you're just looking in a vacuum, you might get lucky, you might make a good decision, but is it great? Is it going to bring synergy to all 6 areas, okay? When it comes to being able to retire, had a situation this week that is just so good. There's so many tax planning opportunities, and it connected all 6 areas of someone's financial life that I just had to share. Now, changing some details here, everything's confidential, but folks that were retired, he's been retired for 4 years, so it's not a COVID retirement, okay? He's an engineer, and then he retired, and they ended up buying a business together, and then they sold the business, and that was about 4 years ago. Well, everything's been going great. They get Social Security, they get a pension. He's got an inherited IRA from mom that he's got to draw some required minimum distribution on. And then because from selling the business, they've got some dollars outside of retirement accounts. They're earning dividends on those. They're living off of those dividends. When you add up Social Security, the pension, the dividends, that sort of stuff, it's more income than they really need. So the other dollars that they have saved up for retirement, they're not drawing off of right now, okay? They're not drawing off of, they don't necessarily need to. Well, so sure enough, the company that he was an engineer for several years ago, they're, like everyone else, struggling to find great talent, and the labor market is tight. And so they reached out to him and said, hey, are you willing to come back to work? And he said, I'm near 70, I'm not coming back to work. They said, well, can you come back and help us with a project? Of course, he reached out to me and I said, are you going to be self-employed? Are you going to be a contractor? Because that's going to be complicated, and I can help you figure it out, but the rate's going to need to go up. You need to be aware of the issues there. And he said, no, they would pay me hourly through their kind of temp employment service. And I said, well, it's up to you then. You obviously don't need the money, but if you want to go back and help out. And so he did. And what last year was supposed to be, he'll probably make about 10 grand. Then, you know what? I'm working more. I might make 20. He made 35 grand. Okay, so he made $35,000, and therefore, when you look at their entire tax situation, that obviously makes some changes. This year, he's still working a little bit, but he promises me he's going to make 5 grand, maybe 10. We'll see. But the fact that he's gone back to work, even later in retirement, creates some new, exciting, interesting tax planning opportunities that we got to figure out together. So the first tax strategy was based on all of that income and their situation, what tax bracket were they going to be in? Well, we did the math. They were in the 22% tax bracket. In fact, they're in the 22% tax bracket either way, because I said he's got a pension, that will never stop. They've got Social Security, that will never stop. They've got the RMD from mom's account. This was back before the Secure Act 1.0, so they're going to draw a minimum amount out of that. That's never going to stop either, okay? And these dividends, let's hope that those don't stop. So they're going to be in the 22% tax bracket regardless. They've been in it by a little bit, okay? Not a small amount. They've been in it by a little bit. And now this $35,000 of income still keeps them in the 22% tax bracket. So we've been talking all along about doing a Roth conversion. Hey, you're in the 22% tax bracket. You're going to stay in the 22% tax bracket. Do you want to pay tax on some of these dollars right now, have them grow tax-free for the rest of retirement and for your kids, and pay tax on them in the 22% tax bracket? They like that idea. And so the first thing that we did is update their tax projection to say, well, now making 35 grand, is there still room to do a Roth conversion? And there was. So back in December, once we knew, okay, well, you're making more, we then said, all right, how much Roth conversion could we do? And we did an appropriate amount, is about 45 grand. So that was tax strategy number one. Tax strategy number two was, in that calculation, we wanted to make sure that their adjusted gross income, technically modified adjusted gross income, but it was the same in their situation, was below the IRMAA threshold, the income-related monthly adjustment amount for Medicare, Part B and Part D. We wanted to make sure that it was below that threshold. Well, guess what happened? Dividends were a little bit higher. Interest was a little bit higher. All of a sudden, we found ourselves about $2,000 above last year's threshold. Because here's the thing, what you pay for your Medicare is based on your modified adjusted gross income from the prior year, meaning 2 years ago. Therefore, what they're paying for Medicare Part B and Part D in 2023 is based on their taxes from 2021. Okay, well, now we just did their taxes for 2022. That's going to influence what they pay for Medicare in 2024. Well, we don't know what those thresholds are, those bands are. We don't know what the income thresholds are for 2024 yet. We do know what they are for 2023. And in 2023, married, filing jointly, as long as your modified adjusted gross income is below $194,000, then you're going to pay the base rate. You're not going to pay any IRMAA extra amount. Well, they were about $2,000 above that IRMAA threshold. And so we sat down and I said, guys, I explained it to them and showed it to them and said, listen, based on inflation, these brackets, these should expand. In fact, I'm 99.9% sure that when we get to the 2024 Medicare rates, the IRMAA is going to expand. It's going to be more than 194,000 married filing jointly that will avoid IRMAA. But I don't know. I can't guarantee it. In fact, there's no guarantee that they won't even reduce it. I don't know. Okay, it's based on formulas, but I don't know. Should we be safe or do we want to risk it? Left it up to them and they said, no, we'd rather be safe. So we put $2,000 into an IRA, an IRA contribution. You might say, you did a Roth conversion and then you contributed to an IRA? That doesn't make any sense. Well, we can't recharacterize any of it anymore. You used to be able to recharacterize your Roth IRA if you did a little bit too much in Roth conversion. You could undo some of it. Can't do that anymore. But because he had earned income, we can contribute to an IRA $2 grand for her. We did it for her. And what that meant is now their income is below that. It was around, I think, 193 $998 after we did the $2,000 into the IRA. So we're below that current IRMAA threshold and gave us a little bit of cushion and peace of mind that we're not going to have to pay IRMAA in 2024. So that's the second strategy. That leads right into the third strategy, and that is because he's got earned income, they can contribute to IRAs or Roths. So yes, $2,000 into the IRA, but again, that keeps them, they're still in the 22% tax bracket. They're comfortable there. Let's maximize Roth contributions for everything else. So we did another $5,000 to her Roth IRA, did $7,000 to his Roth IRA. Now we've got more money growing tax sheltered, tax free for their future. Guys, I just can't stress it enough. Comprehensive financial planning and specifically tax planning. What that did is it brought in together, right, their cash flow because they were making more money. So we had extra cash flow. Didn't necessarily, we weren't thinking 401k contributions, all that sort of stuff, but they had extra income. That present financial position, they were in a strong position to make contributions to their retirement accounts, even though they're in retirement, okay? Help their tax plan. We made sure it was appropriately invested for their risk tolerance, their risk situation. We know that their retirement plan is on track, and therefore likely the kids are going to inherit this. Therefore, doing Roth conversions and contributing to the Roth makes a lot of sense. And from a protection planning standpoint, avoiding IRMAA by making this $2,000 IRA contribution, guys, that's a great strategy as opposed to just good, right? Work with your certified financial planner. Get all 6 areas of financial planning, specifically tax planning this time of year. Just makes a ton of sense. Work with your CFP on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.